if you don't answer half the exam, there's not a whole lot you can expect, you know, so whatever. But some of the other people improved, so that's good. All right, next week in this classroom, oh, let's just mention, because now, boy, this term is going so quickly, and next term I'm stuck with that online class with 34 students. Plus I have auditing, which I haven't taught in a while, but I'm looking forward to that, and I want to thank the students in here who signed up. We should have a safe enrollment now. And I've got Accounting 324, which is the undergraduate Tax 1 that I've done twice before, but it's been a year since I did it. But next week we'll be turning in a hard copy, believe it or not, a hard copy of our You Decide paper. And I want to just comment, the You Decide project is very hard. There's no right or wrong answer. What I will do is I will go through the papers over 3 different days. The first day I'll kind of put them in an order of the most well-developed versus those that are less well-developed. And I usually put down a score on a piece of paper and a couple comments for myself, and then I hide that sheet of paper. Then I'll do the same thing the second day, and then I'll also do it the third day. And then I'll compare the 3 to come up with the ultimate results. Now, this project was done January term in the loop, 125 possible points. I'll just give you an idea what their scores were and a few general abbreviated comments. Remember, 125 was the max. 120, more citations needed. 120, more needed on corporate reorganizations. 120 is great. More needed on net operating loss limitations and which type of reorganization is appropriate. 125 out of 125, oh wow. 120, more detail needed, especially about corporate reorganizations. 122, needed more research sources. 125 again. 120, more research citations needed. 120, these are all good scores, more needed on section 381 and 382. 120, better citations of research sources needed. 120, more citations needed. 90, no citations, too abbreviated. 115, more needed on type of reorganization A through D, better citations for sources. Some sources are not cited. So they did pretty well. There were 2 lower scores, although 115 isn't bad out of 125. The 90 isn't bad, but a lot of those, and this is a loop class, did pretty well. So in here I'm envisioning some good results. This is a hard project. There's even the instructions for me, there's no right or wrong answer. But let's talk about it briefly. And a lot of times this used to be in the course shell. And they put something else in here which is not nearly as good. And they're always talking about typing memos and stuff. And basically I'm not looking for a memo. I want you to do it question by question. Now let's talk about it briefly. Question 1A. They're talking about a wealthy guy acquiring another company. And it has some net operating losses. For part 1A, this is a broader overview part where you're going to go summarize some of the things you're going to do, and then you go into more depth about them later in the paper. One thing now, these are just advice for me. Students should address whether we should leave the new company intact for purposes of utilizing, here's one of the key factors, the use of net operating loss carryovers. The use of net operating loss carryovers. Now, in that area, identify the limitations. This is advice students should. Identify the limitations on net operating loss carryovers. Now, I would recommend you look at Code Section 381 and Code Section 382. I actually put that in the online discussion today, and I talked about trafficking in net operating losses. Trafficking in net operating losses. I'm sorry? Oh, oh, okay, okay. Do you think can you close the door for me, because it's getting a little noisier there? And we're open, but I think we should be closed for a while. Thank you very much. So net operating loss carryovers, can we use them? If we have C corps, we probably can use them. If we have an S corporation, we probably could not use them. Now they mentioned in here, I would not have, that I would have thought of. They also mentioned students can identify the dangers of thinly capitalized corporations. The dangers of thinly capitalized corporations. Let me comment on that. One of the issues here is, should we rely on stock or debt to make the acquisition? Does anyone know from business law, what is a thinly capitalized corporation? This business law concept. Okay, well, I'll comment on it. Bill, my brain is wiped out from the exam. I understand. It's if you don't have enough invested capital in the company. In other words, you rely too much on debt and don't have enough personal investment in the stock of the company. So that will impact not the use of the NOLs, but that would impact whether we use stock or should we rely on debt for the acquisition, because that's part of question 1A. Should we purchase the stock outright? What about issuing debt to pay for the stock? Then it says students, now this you could just introduce because this will be covered in great depth in a later part of the questions. Students should discuss tax-free reorganizations. Tax-free reorganizations. Then it says there's no right or wrong discussion answer here. Identify the issue as the major resolution of what should be accomplished. Students should support their answer. So I think that part 1A is a more, kind of like a goal. A little bit about the NOLs, a little bit about stock versus debt, and a little bit on corporate reorganizations, but those will be pursued in more depth later on in the project. Now they have a question 1B and a question 1C. Would you mind if we combine those together to make it question 1B, comma C? I think those can go together. Basically, they're saying, should we convert to an S corp? Should we change year ends? First of all, an S corp has to have what year end?
12/31.
12/31, exactly. S corp must be calendar year. And then they're saying, what would be some income tax ramifications if the guy buys it personally? So I'm going to combine question 1B and 1C together. It's here on the front page. At the bottom, it says 1B, should Mr. Jones convert Smith-On to an S corp and change the fiscal year to a calendar year? And 1C, what potential? Barry, can you show her too if she needs guidance? So combine those as one. Combine those as one. We'll call it question 1B, comma C. Let's think about it. I'm combining them together. I don't think, so we'll have question 1A, then we'll have 1B, comma C as our second part. Let me ask you a question. What type of entity did we say an S corp is? Pass through. Pass through or flow through, yes. So if this is a wealthy guy, under current law, what would be his maximum income tax rate if he's a wealthy individual? What could it be as high as?
It was 39.
39, right. 39.6%. Tracy's right. 39.6%. So if it's an S corp and it starts generating income, taxed at 39.6%. If it's a C corp, what would be what's the maximum tax rate on a C corp right now?
40?
No, it's 35, but there's a lot of talk about reducing it. If we get a Republican president to go with the Republican Congress, it'll be reduced. No question about it. Although I think some of the arguments they're using to support the reduction have holes in them, but anyway. So that might be one consideration. And what about the net operating losses? Could we use them if we did the conversion? Now, question 1D. Should Mr. Jones basically merge? Or what type of merger or acquisition would be best? Now, for this part of the question, Code Section 368, 368. That's corporate reorganizations. Some of you have already been posting. I know we had Tracy, for example, did an article that covered all the major reorgs. Now I have people concentrate on just talking about one type. You only need one post on that second screen this week.
Oh, that was 36A?
368. 368, and either an A reorg, which is a statutory merger, or a B reorganization, that's stock for stock, or a C or D reorganization, which is stock for assets. Select one of those, briefly describe it, and indicate why you think that you would recommend that type of reorganization. Now, be cautious. Some people did some research in January, say, well, we should do a horizontal, I want A, B, C, or D. A, B, C, or D. Select one of them, describe it. Again, there's no right or wrong answer on this part. Section 368 will deal with that area. So that would be question, we're going to do question 1A, question 1B, comma C, question 1D. Now question 2. If we do merge them, can we use the net operating loss carry forwards and any limitations? Here's where we're going into the net operating losses in greater detail. We talked about section 381 and 382 and the trafficking in net operating losses. Also code section 172. 172. So take a look at that, see if we can use the net operating losses. If we can, remember, I think someone mentioned this, I might have been Tracy earlier in the term, NOLs can be carried forward how many years? Well, it's back to forward 20. Yeah, so I mean, you know, that's a long period of time. So little on that area. Somebody emailed me in the other class, how many pages or how many words? Well, she said, would a short paper be fine? And I just said, if a paper is too short, probably you wouldn't go over the topics in adequate depth. I had one over-energetic student once turn in 20 pages. That's ridiculous. I read it. It's good. But I mean, there's only so many hours in the day for you. But 2 pages probably wouldn't be enough. I personally would probably do with, you know, normal double spacing, I probably would do 5 or 6 pages. And make sure you identify your sources. And they don't have to be all research sources, they could be making reference to code sections or a revenue ruling maybe.
Is there a specific way you want us to cite?
I'm informal. I know it's the, what is the APA requirements and all that. They got me teaching the 525 course in the future, contemporary issues, where I've got to follow all those crazy APA guidelines and everything. You know, and I'll have to do it there. When I was in law school, we had the uniform Harvard citator that was kind of like the APA, you know, ways you had to identify things. I'm much more relaxed. But with other faculty members, beware, because I guess the official rule in the school is that.
So can you just say like, okay. Can you say like according to section 381?
Yes, 381A1B2.
Okay.
Well, that's the way the code section.
Do we need like footnotes and stuff, or we can just do a works cited list?
If you did a works cited list, you probably should put like, you know, like you put like sources 1 through 6,
okay.
And then identify like the number 1 whenever you used it,
Got
so
it.
I can identify that with the paragraph or
Okay.
so.
Sounds good.
Now, Part 2B. This is something, again, in Part 1A we just kind of skewed over. Should we use stock to acquire the company? In other words, or debt. Let's talk about this a little bit. If we use debt, what's one benefit? Now, we talked about the dangers of thin capitalization. But outside of that, if you use corporate debt to finance the acquisition, what would be a tax benefit of using debt? That's right. Amy's right. Tax deductibility of corporate interest.
Do we want to talk about, what's it called? Miller and Modigliani? You know what I'm talking about.
Oh, feel free. Anything else
Okay.
you want to bring in here? I enjoy this. You know that very much. For this purpose, though, I was just thinking tax deductibility of interest. If we're paying tax at a corporate rate of 35%, the government's subsidizing 35 cents out of every dollar of interest in the form of tax savings. Because, for example, C Corps don't have a standard deduction. What's a disadvantage of using corporate debt? Go ahead.
Like debt ratio or how your creditors would.
Well, it could be. And do you have to pay the interest? Yes, yes, yes. You have to pay the interest. I mean, it's not like, well, geez, do we feel like paying interest or not? No, the debt payments require interest to be paid. What if you use stock? Do you have to pay a dividend on stock? Do you have to on common stock?
No, we don't.
No, it's discretionary, isn't it? So that's something in favor of stock. If we have liquidity problems, we don't have to pay a dividend. Now, somebody on Tuesday night said, well, won't that have an adverse impact? Yes, it will. I'm sure your stock price will go down. But if we're talking about a closely held company, it doesn't make that much difference. But is there any tax benefit of paying dividends? Do you get to deduct dividends in determining taxable income? No. No. So you can deduct interest paid on corporate debt, but you cannot deduct dividends that you pay to shareholders. So that might have an impact on your decision, or you should discuss it briefly. Now, another factor that I wouldn't have thought of, I haven't had this since the late 70s or early 80s, but they say students may want to discuss whether or not this could be qualified small business stock. Small business stock. Now, my recollection is, and this is not in this recommendation sheet, I think that's called 1244 stock, section 1244 stock. Many years ago, I think when I was in public accounting, I had a client who had invested in the O'Hare Port Hotel, which was along the tri-state. But at the time, there was no exit ramp right by the hotel. So it went under. So it was 1244 stock, and he took a loss on it. Now that building still's there, and there's now an exit ramp, but it's a retirement community. It's a high-rise retirement thing. It's on the east side of 294, heading up to O'Hare. I remember it because, I'm sorry, I'm getting diverted. There was a billboard that you could see from the retirement high-rise, and it was for a radio station, and it showed two people's posteriors mooning, and the caption was "Wisecracks," and I guess the old people didn't like it or something, so they protested and they had to take the billboard down. But it got so much publicity for the radio station, it probably more than accomplished its purpose. So look at 1244 stock, look at code section 1202. Maybe you can introduce those into your discussion. And there's more commentary here for me, and it basically is the same thing we just talked about. Then 2C is kind of a short thing, and 2D, the last part. I think they're shorter. Would a merger or acquisition affect Mr. Jones's ability to change Smith-On's fiscal year to a calendar year? Could he convert it to an S corp? And again here, two factors we should mention. Let's write one we've already mentioned. We should mention another one. One is that an S corp can only have a calendar year. But something else I think that we should mention here, and you're probably aware of it anyway. A C corporation cannot own an S corporation. A C corp cannot own stock in an S corp. So that could influence our decision as well. So I expect a shorter answer on 2C. 2D says, would your decision, does the potential of a significant capital investment affect any of your answers to parts 2A through C? A couple sentences there. It's going to be yes or no and give some kind of a reason. I'll read you what they have down. In this suggested answer, it said for A, yes, if the two companies were merged, they could use the net operating loss carry forwards and reduce taxable income. Students should include a broad overview of their subject matter that they've studied. B, they said they could use the stock. Okay, what's it? Oh, saying that. Okay, I see what they're saying here. Again, if you convert it to an S corp, you would lose some of your capability of being able to utilize the net operating losses. And then it said for part C, comma, no. So I'm not expecting much on 2C or 2D. And like I said, I'm just seeing how well you developed your answers. There's no right or wrong answer. This would be a much higher level project. And I'm just going to compare your papers with those from the other class, which should actually help you. Is it due Sunday night by 10 o'clock? No. No, I'd like you just to kind of bring out a hard copy and bring it into the room next week. And if for some reason you can't be here next week, the Dropbox will be open if you want to stick it in there. But it's just as easy to just copy it up and bring it in and put it on my table here. So that gives you a whole week from today. Next week on the posting, by the way, next week's posting, we're doing 3 posts on computer screen 1, and we're doing just 1 post on computer screen 2 over the usual 3 days. So don't forget, we are meeting. I sent an email out to Len yesterday, but today I think there was a big meeting at corporate. I know the Lou Ponchos were all concerned about that. Well, my boss doesn't have a car, yet he wants me to drive everywhere. But at any rate, he would have to have hitched a ride with somebody to get to Downers Grove. And so I haven't heard yet about a classroom. I don't think we get this classroom because I think it's in use. But we're meeting the Monday of week 8. Next week we'll meet on Thursday, Monday of week 8. I'm going to make it meaningful, so we'll do a relaxed. It's the benefit of week 8. I always had to rush this in week 7. And sometimes I didn't get over the multiple choice. But in week 8, because we're meeting, probably in a different room, we'll have a relaxed consideration. The only person who expressed inability to attend, remember, was Lena. She and I talked about something before. She's going to make some arrangements, maybe for someone to operate her equipment here. And then she can pick it up from me the next day. So please try and come. Any questions you have on any of the content, we can answer it. We'll have the full time to do it. I think it should work out well, and I think it might help the scores. I will then ask you if you can, if you could complete the exam by Wednesday or Thursday night to make Bill's life a little bit easier. It opens on Sunday, but you don't want to open it till we've had the review, please. There's one taking. They gave 3.5 hours. That's ridiculous. Bill's adding an extra hour. It's still going to be tight. But if you're ready, you should be fine. Okay, it'll be multiple choice and problems, and we'll talk about it in depth at that time. Also, the course survey will be opening. I'd like you to do that and then email me a confirmation. And we're not allowed to officially provide credits for that, but setting up a curve is always discretionary, isn't it? So I smile upon people who do the survey and also complete the exam before the last day, because it makes life a little bit easier for me. I am not one of the anointed ones. Lena's Lena's in a class with an instructor who does things that, I mean, he's a nice guy, and he and I are friends, but for him to be one of the anointed favored ones, to me, seems inappropriate, but whatever. So I need your support. The center here loves me. They treat me with respect. They recognize my birthday. We have a little celebration. I get no recognition of the loop. I'm just happy if I don't get yelled at. So hopefully you'll think that I surpassed expectations. But, put your concerns down. There's 2 surveys. The one I'm concerned about is the one about me. The other survey is the one about the center. That's the MPS survey. I think they call it student satisfaction. And that one, of course, relates to the Naperville Center. And please, for that one, only indicate items that are within the control of the center itself. If you say tuition is too high, they have no control over that. That comes out of corporate. But, if you like the baked potato bar or something, or you think that, there should be more vending, I don't know, whatever, then, put down comments of that nature or something, or, your experience with the MPS with the advisors, Amanda or Melissa. That would be the type of thing for the MPS. But I'll be talking about that again next week. Okay, let's come over here. I promised you that we would go over some depreciation stuff again. So we're going to do that. Then we're going to introduce, but we're going to spend more time next week talking about capital assets. I have some interesting handouts I want to bring in next week to clarify capital assets, 1231 assets, etc. So your minds are probably spinning already from the exam, but next week we won't have any exams, so that will be beneficial. We'll also talk next week about the 1231 netting rules. Some people have already posted on that. How non-capital assets can get capital gain treatment. We also will talk about Chapter 14 in depth, including Code Section 351. I'm going to set up a spreadsheet on the board. We've got some excellent supplemental problems, and we'll be solving those using the spreadsheet together. So it should be a rather momentous session. First of all, let's come over here, though. Last week we had this was because it was also over here. This is if the Makers Mid-Quarter Convention applies. If it applies. The left side had acquisitions. And I have percentages here, but we don't need those percentages because they're already built into the tables. These percentages we need because the tables don't know when you're going to dispose of something. Now please notice, these percentages, mid-quarter convention, only apply to personal property. That's non-realty. Sometimes on exams, students have so much in their heads, they get confused, and they start using this for real property. No, this is personal property. First of all, I need help, though. What determines if the mid-quarter convention applies? What is the test? Somebody on Tuesday said it's an 80% test. That's not correct. What test is it? Anyone remember this?
Is that the 40%?
Tracy's
in the last
right.
quarter, 40%?
No, that's right, Tracy.
40% placed into service in the last?
That's right, if more than 40% of all the personal property. So if more than 40% of the 3, 5, 7, 10, 15, and 20-year property If more than 40% of that is put in service in the last quarter, then the mid-quarter convention applies. What if that is not true?
Half-year?
Half-year convention. So let's take a look. Last week we had 5-year property. This week we have 7-year property. 20,000 in the first quarter, 20,000 in the second quarter, 5,000 in the third quarter, 300,000 in the fourth quarter. This looks like $345,000 is more than 40% in the fourth quarter. Oh, hell yes. So mid-quarter convention applies. These are the dates that the properties were put in service. That determines the quarter. Let's just do year one first. Which table do we use here for the, well, you probably don't have this with you today because you had all the stuff for the exam. So I'll give this information. So for the first quarter property, I'm looking at table 2. Table 2. I'm looking at the 7-year column, year 1. If anyone does have this, if I make a mistake, please call it out. 7-year property, year 1, table 2, 25%. Make sure on the final you do all the math. I'm just not doing it up here. 25% times 20,000. For the second quarter property, table 3, 7-year column, year 1, 17.85%. And Amy's got tables there. If she could check in case I make any mistakes, if she could reconfirm. Third quarter property, table 4, 7-year, year 1, looks like 10.71%. Then the table that causes it all, the fourth quarter table, table 5, 7-year property, year 1. Look how small the percentage is, 3.57. That's because it's only 12.5% of a full year. 3.57% times 300,000. And we'd be done now for year 1. Now we're a year older. Wiser, I'm sure. Year 2, first quarter property, table 2, 7-year column, second year 21.43. 21.43% times 20,000. Now, if, as in one problem on the exam, final, that were not disposed of, that would be it. 21.43% times 20,000, that would be the answer. And there'll be a question on the exam, on the final, where you're going to have to do mid-quarter convention for 2 years. There's no disposition, so you'll be done. But there's another problem on the exam that a third of you will get, where there's a disposition. Here the disposition is on August 8th. August 8th. What quarter is that? Third, that's right. July, August, September. So that you would then take times 62.5%. Everyone with me? If you have questions, remember, at our review, so start studying this area as if you knew what the final's like, so we can have plenty of questions. Second quarter property, I'm going to table 3, 7-year column, year 2, 23.47. And on the exam, if there's no disposition of this property, that would be your answer for year 2. But to make this more stimulating, we disposed of it March 31st. So that puts us in the first quarter. So we'll have to take that times what? 12.5. Remember, these percentages only apply because we're having a disposal, a sale, or exchange. Table 4, third quarter property, 7 year, year 2, 25.51. Times 5,000. Now, if there were no disposal, as on one question on the exam, that would be it. Do the math, put it down. But this was disposed of November 10th. So that puts it in the fourth quarter times 87.5%. And finally, the fourth quarter property, table 5, 7 year, year 2, 27.55. If there were no disposal, that would be the depreciation for year 2. But there was a disposal on June 20th. April, May, June puts us over here times 37.5%. Now, look this example over at your leisure. Look at the one last week. Accumulate questions for Bill, or if you want to do some hypotheticals or something in class at our review, that would be acceptable as well. Now, I'm trying to get blue out of here. Let's say that everything was the same as what we just did, except this, instead of being 300,000, was 3,000. So 20, 40, 45, 48,000. 48,000. Now, if this were 48,000, 40% of 48,000 would be basically tell us that 3,000 is not 40% or more of 48,000. That'd be around, what, 16, 17,000. So mid-quarter convention does not apply. So now we're at the half-year convention, whereas under half-year convention, when is everything deemed to have occurred for a calendar year company?
July 1.
July 1, that's right, June 30th, July 1st, let's slice it right there. So we're going to table 1, 7-year, table 1, that's half year, 7-year column, year 1, 14.29%. Times 48,000. Notice we don't have to separate these by quarter because everything is deemed to be right in the slice in the middle of the year. Year 2, 25.49%. Times 48,000. Now, if on that one question on the exam, there's no dispositions or sales, that would be the answer is just do the math.
Where'd the 48,000 come
Oh, let's go over that again. 20 plus 20 is 40, plus 5 is 45, plus 3 is 48.
from? Okay.
Now, that's a good question. Anyone with us here? Okay, now, if there were dispositions, these dates of disposition, do those dates matter? No, because everything is when? June 30th, July 1st. So this will automatically be times 50% if there are dispositions. If there's no dispositions, then this, of course, would not be down here. It would be simply 24.49% times 48,000. So what do you think of that?
So half-year convention, there's only one table to refer to.
That is correct. Excellent. And everything gets combined together within this 7-year classification. If we also had 5-year property, That would be just table 1. It would be all combined together, yes. But look these over, these examples, because with the 8 weeks, we do have time for questions. Here's another thing we looked at last week. We have another opportunity. Last week it was $2,200,000. On the exam for 1/3 of you, not everyone unfortunately, $2,100,000 it'll be. This is using the figures, what's underlined in red is by statute. That's been true for about the last 4 years. $2,300,000 piece of property, here it's 5-year, half-year convention. We want the maximum allowable depreciation in year 1. So we're going to claim 179. Remember, 179 is restricted to small business. And to determine what's a small business, Congress decided that, well, if you have qualifying asset acquisitions that are greater than $2 million, you're starting to get a little bit too large. So 2,300,000 minus the 2 million, we're small but not small enough. We're going to lose 300,000 of 179. Remember 2 weeks ago in Donna's post, she said the ceiling is 2,500,000 because at 2,500,000 you would have basically phased out the entire potential 179. 500,000 is the maximum. We're assuming 100% business usage. Minus the phase out because we're a little bit too big of 300,000. So 200,000, 179 we can claim on the 4562, the first part of that, which is the 179 section. Remember, this is additional depreciation. They call it the expensing of assets. But when we talk about depreciation recapture next week, which is another laudatory topic, is depreciation. We're also going to elect the 50% bonus depreciation, which we still have available through the end of 2014. Take our cost, back out the 179, subtotal 50% by statute, $1,050,000. Now, we have to compute depreciable basis. Both of these are additional depreciation you can claim up front. What did we say was the reason for these? Why do we have the 179? Why do we have bonus?
To get them to spend money to buy capital or capital expenditures.
That's right, Tracy's right, exactly. We'd always had 179, and we used to have a bonus depreciation that was like 179 under ADR. But the 50% came in after 9/11 for the reasons that Tracy listed, and I guess they're still saying we're hurting. Take the original cost of $2,300,000, back out the 179, back out the bonus. So this figure here, this $1,050,000 that I've circled in green, is what we're going to use for the tables. Because we also get to do regular depreciation. Year 1, take this $1,050,000, that's this in green. This, remember last week, table 1, half-year convention, year 1, 5-year property, 20%. Regular depreciation is 210, plus the 200 for 179, plus the bonus. Here's the year 1 depreciation. This is from table 1, half-year convention, 5-year property. Year 2, 32%. Year 3, 19.2. It's a lousy percentage sign, isn't it? A little old here. And this is times this $1,050,000. Look that over, look the example over from last week. Lena, sit.
Oh.
Sit down so you can adjust that. See if you have other questions. We'll have something slightly, just a little different on the final. And we'll talk about it leisurely, being we get to meet in week 8. Whereas before it was never leisurely. This is the one class, 553, where I'm happy that we have a week 8 meeting. Not as happy about it in Management 520 this term, but Now, listed property. This is also described in this thick handout. And you probably have done, if you have insomnia problems, you've probably been looking at this. It's on page 746, 747. And they describe what listed property is. Passenger automobiles and other property as a means of transportation, etc. Cell phones were down here. You researched that for me last week. They're no longer qualified because cell phones are not the luxurious item. And they describe what a passenger automobile is. By the way, there are special rules that I'm not testing or going over for SUVs, for those of you driving those vehicles. They're not as tight, but there are restrictions, but they're not as stringent. If you have listed property, like a passenger automobile, it must be used greater than 50% for business purposes, or, now notice it's not 50% or more, it's greater than 50%. Or you get no 179 deduction, and only SL, straight line depreciation. Bill, there's no tables for that, doesn't matter. Straight line depreciation, you just take the capitalized cost divided by the life and use a half-year convention. There's no salvage value for tax, remember. No salvage value. Well, let's go back in time. I can remember this, probably most of you cannot. It's the year 1984. It's the year of the Deficit Reduction Act. At that time, one of the most prestigious vehicles that you could have purchased was a Mercedes 450 SL. Sold for about $85,000. Of course, 100% business usage. Now that's an acres year. So that means we could depreciate that entire vehicle in 3 years. Because remember, cars under acres, 3-year property. 5-year now, but 3-year property. And there was an option where you could also get an investment credit if you reduce bases. Well, the luxury auto rules were incorporated there, and immediately Germany complained, saying that this was anti-German because of Mercedes. But the luxury auto rules, and I show what they are for 2014. I don't have the 2015 figures. This is from Revenue Procedure 2014-21. Assuming 100% business usage, the maximum depreciation that you can take per year, $3,160 in year 1, $5,100 year 2, $3,050 in year 3, $1,875 in year 4, 5, 6, 7, 8, 9, 10, etc. You buy a $100,000 Mercedes, 100% business usage. Can you depreciate the entire car? Yes, but it's going to take you a hell of a long time. Now, luxury. You're saying, well, I don't have any luxury vehicle, Bill. I have a Ford Taurus or something. Well, let's see what luxury is. Now, let's say I have a $15,000 car, 5-year asset under makers. Let's say half-year convention. Okay. So that was, remember, that's the 20% that we saw over here. So take 15,000 times 20%. That's table 1, half-year convention, 5-year property, year 1. And that's $3,000. So depreciation, that's not a luxury auto, because that's $3,000 is below $3,160, depreciate $3,000. $16,000 car. Take it times 20%, table 1, 5-year assets, half-year convention, year 1. That's $3,200. That's luxury. You can't take the $3,200, can you? How much can you take? $3,160. $3,160. So now I must confess, if I have a new vehicle that I paid $16,000 for, that's not luxurious, but it falls afoul of the luxury auto rules. Now, not for the exam, but for real life. First of all, if this were 80% business usage, it's 80% of 3160, 80% of 5100. Those figures are the maximum, assuming 100% business usage. And here's the tax planning idea. If you have a vehicle, let's say you say it's 80% business usage in year 1. If in year 2 it drops to 70% business usage, they make you go back and redo year 1 as if it were 70%. What if it was 80% in year 1 goes to 90% in year 2? They don't let you go back and do that. So does it have to be exactly the same? No, but I would keep it within like 3% business usage. So it was 85, 80 one year, maybe it could be 82 the next year, you know, maybe 79 the next year. Keep it kind of in those guidelines. Down at the bottom, we mentioned this last week, but I did not in the other class. If you have property received from related parties, you do not get a 179 deduction, but you can get bonus depreciation.
So can you always get bonus depreciation in year 1?
If you elect it and it's qualifying property, that is correct. That is correct.
So with a vehicle, if, say, whether it's a business owner or whoever has a company vehicle and it's their only vehicle.
Let me comment on this. There used to be a question on the form 2106. Anyone, you probably are familiar with the 2106.
I've seen it.
Yes. And it said, do you have another vehicle available for personal uses? If somebody put down no, and then they claimed 100% business usage, did they ever go to the Jewel? Did they ever go to church? I mean, give me a break. So yes, yes, and they can check that. And remember, one thing you probably should be doing, it's what we did in the military, I remember. If I took a vehicle out of the motor pool, because I had a military driver's license for like the Jeeps and stuff, or whatever, they weren't called Jeeps, they had some other fancy name. You had to record the odometer reading when you left and when you came back and do some maintenance. So it's not a bad idea to keep a logbook where you record the mileage when you leave home or when you leave a place of business to the next destination, to substantiate business miles versus those that are personal. But that's the next